So open enrollment has different meanings, different aspects. There are those of us who work for a mid-size or larger employer where we're given a kit each year where we pick what health plan we're going to go into, what other benefits we might buy, and the employer may or may not offer some allocation of money where they subsidize the various premiums. They offer maybe short-term disability, long-term disability, life insurance, dental insurance, and maybe a few other stray things that are offered. And you pick and choose and you end up with an amount that's deducted from your pay each month. Then there are people who are having to buy coverage for themselves, which is actually a very small part of the insurance market. What you buy on the federal state exchanges, that the umbrellas, healthcare.gov, and then if your state has its own exchange, it will take you directly to the state thing to pick what's known as a compliant plan. That's one that has required federal coverages that are color-coded. Bronze, silver, gold. There's virtually no platinum plans anymore. But you pick, and that determines what deductibles you'll have and what out-of-pocket you'll have, and then at what point you're covered with no limit on the coverage if you end up with something that's really catastrophically expensive. There are some wrinkles that you can buy. There are certain kinds of federal plans where you can buy catastrophic coverage, and so there's some variety there for you if you're self-employed. As of now, the additional support from the feds on what premium costs are for so many people that went into effect in 20 during the pandemic, those are still going on. So for people who buy their own individual policy, the premiums for many people, for most, are being subsidized by your fellow taxpayers. So the cost of buying a fully compliant plan is cheaper for yet another year than it would be if you were paying the prices as would be required as the law was originally written. For people who buy coverage at work, depending on the size of the employer and how many options they offer, you may have different levels of deductibles you can buy in your health plan. The higher the deductibles you take, the lower your deduction from pay each month. You really have to think through what's going to be cheaper. Many employers, taking the higher deductible and having the lower out-of-pocket each pay period will actually end up costing less even if you use a fair amount of health care. You have to run the numbers under your employer plan. You also may, if you're lucky, have the option of an HSA eligible plan from your employer. If you are generally healthy, or you're at the other extreme where you have a significantly expensive chronic condition, an HSA can be a grand slam for you. An HSA eligible plan allows you, in addition to having your health coverage, you've triggered eligibility to put money into the greatest tax deal Congress has ever offered us as working people or business owners. Because the HSA is the health savings account, is an account that you get to put in pre-tax dollars. The money grows tax-free in your HSA, and then the money in the HSA used for eligible medical expenses is spent tax-free. So you get all those earnings tax-free, you use pre-tax dollars to go into it, and then you spend it tax-free. I mean, it's unbelievable. It's even better than my beloved Roth IRA is a place to stash money. Now, remember I said if you are extremely healthy, don't draw on medical a lot, the HSA is incredible. If you have very expensive ongoing chronic conditions, the HSA eligible plan is awesome because it has a tight cap. Once you meet your deductibles, you're done with what you're paying out of pocket. From that point forward, the HSA eligible insurance is paying for stuff. So for people in the mushy middle who have ongoing medical expenses, you don't have a lot of money to draw on if you were to have large deductibles. Going in the traditional employer plan is best for you if your doctors recognize you on site when you come in the door, but not that you're there every week, then you're probably better off in the traditional health plan your employer is offering. With HSAs, if you go into one and you're in an HSA plan, and let's say you're an entrepreneur, you own your own business, you're in good shape financially, you never want to use the money in the HSA account to pay your deductibles, to pay the money that you're having to pay out of pocket for health care. You want to pay that money straight out of your pocket and let that HSA keep growing tax-free, not tax-deferred, tax-free for decades. It ends up being a huge pile of pre-tax dollars that accrue to you tax-free that you can use tax-free much later in your life. Unbelievable. And you know what else? HSA money does not have to be with these terribly high-cost administrators that sadly a lot of employers use. HSA money can be with low-cost providers like Fidelity or Vanguard or something like that. Fidelity's been really big in this area. And you can invest that money, again, because you're not using it for current medical expenses, you're using it way down the road. You can grow that money in investments at ultra low costs and have it build up this giant stash of cash for much later in your life. So that's like a quick windshield survey of open enrollment. But I wanted to add one thing I neglect to mention till somebody asks me the question. Employer-provided life insurance. A lot of employers provide you through open enrollment with a certain amount of life insurance free. It's a term policy, meaning as long as you're there, you're working there, you have this insurance, and you die unexpectedly, it will pay your designated beneficiary, or if you haven't designated one, your estate. If you are given the option, which you usually will, to buy additional life insurance in that plan, only do it if you're not going to medically qualify to buy your own level term insurance policy. Because employer insurance that you have to pay for life insurance usually is not a deal. You want to instead take the coverage that you can buy on your own in a level term policy. And I got a good explanation about how level term works and how to buy it on Clark.com. The other thing a lot of people overlook that's offered in open enrollment is long-term disability. You have a 3 times greater chance during your key working years of becoming disabled than passing away. So disability insurance pays a percent of your income, usually 60 or 70%, in the event you are not able to work because of a disabling injury or illness or whatever it is. So disability insurance is a really, really valuable thing to have. It's not particularly cheap, but through the employer plan, if it's offered, please grab a hold of long-term disability.